In December, China sold $57 billion in U.S. Treasuries, and we would add, bought $4 billion in gold. 9 out of 12 months in 2024 saw reductions in China's U.S. Treasury holdings. The 3 where they added were very modest, almost like noise. The data points to a strategic long-term shift in China's reserve management approach. Analysts say the change partly reflects China's desire to diversify, de-dollarize, diversify, replace, because of the fear of sanctions, which leads to the fear and execution, possibly, of wealth confiscation.
According to data from the U.S. Treasury Department, foreign holdings of U.S. Treasuries declined in December as the 2 largest foreign holders, Japan and China, reduced their portfolios. Total foreign-held treasuries fell to $8.513 trillion in December from $8.633 trillion in November, continuing a downward trend from September's $8.679 trillion. Japan, the largest foreign holder, cut its holdings to $1.060 trillion from $1.087 trillion, marking the lowest level since 2018. Meanwhile, China reduced its holdings to $759 billion from $768.6 billion in November, bringing its total decline for 2024 to $77 billion, the lowest level in 15 years. The sell-off occurred as Treasury yields surged in December, driven by expectations of more substantial economic growth and potential inflation pressures following policy shifts under the incoming Donald Trump administration, including proposed tariffs and immigration reforms. Market analyst VinceLanci notes that China's ongoing reduction in U.S. Treasuries is part of a broader strategy to diversify its reserves by increasing gold purchases. Throughout 2024, its Treasury holdings declined 9 out of 12 months, signaling a steady shift toward gold as a reserve asset. This trend is reinforced by China's domestic gold market, which showed improvement in January. The People's Bank of China increased its bullion holdings for the 3rd consecutive month, reflecting a continued commitment to gold accumulation. While gold imports lagged and ETF flows turned negative, overall sentiment suggests rising gold consumption in the months ahead, according to Ray Jia, research head for China at the World Gold Council. Lanci further highlights the potential impact of China's insurance industry increasing its physical gold purchases, a factor not fully accounted for in Goldman Sachs's price projections. If these purchases materialize as expected, the upside for gold prices could be significantly higher than Goldman's $3,100 target, reinforcing the broader trend of China's strategic reserve diversification away from U.S. Treasuries. Make sure to tune in for our expert analysis. Don't miss out on future content. Hit the subscribe button and turn on notifications to stay in the loop.
Why Goldman's 31 target is low. We'll get to that first. Goldman reiterated its buy gold trading stance. The bank emphasized gold's value as a hedge against risks such as trade tensions, potential Fed policy missteps, and recession threats, noting these could push gold towards the upper end of its uncertainty bullish range, actually. Given that Goldman's analysis does not factor in the Chinese insurance industry's incipient physical offtake, we think Goldman is holding back on their bullishness. The higher upside is all but certain if China's insurance industry buys in. The full analysis link is at bottom there. Why Goldman's 3,100 target is low. That chart, which is in the report, and we cover, if you want to look at that chart, I'd like you to focus on the red dotted line and the gray dotted line. We've been tracking those lines since October of 2024, when Goldman started opining that first central bank buying would slack off in 2025, indicating a lower gold target. They actually had lowered their target or backed off and kicked their bullish target down the road a little bit. And now that line has gone from low, that's not showed, to gray, right, to red. Now, the significance of that line is something we'll discuss later on. But you're raising targets on offtake. You're raising targets on price. Anyway, that full analysis is in the post, why Goldman's 3,100 target is low. Next, China sells more treasuries for gold. This is brand new information. I think the FT broke it, but here's the key. In December, China sold $57 billion in U.S. Treasuries, and we would add, bought $4 billion in gold. 9 out of 12 months in 2024 saw reductions in China's U.S. Treasury holdings. The 3 where they added were very modest, almost like noise. The data points to a strategic long-term shift in China's reserve management approach. Now, I'm going to read to you an excerpt from the FT, and they say, quote, China's holdings of treasuries have fallen to their lowest level since 2009, as Beijing holds more of its U.S. government bonds through lower profile accounts and diversifies into alternative assets. Analysts say the change partly reflects China's desire to diversify its foreign reserves by buying assets such as gold. But they add that Beijing is seeking to disguise the true extent of its treasury holdings by shifting them to custodian accounts registered elsewhere. Interesting take. It's the first time I think the FT's actually mentioned that they're buying gold, but it's the gaslighting, even though they're backing off on the gaslighting. Alternative assets, an alternative asset means something that's different. Alternative music, alternative food. It doesn't mean something that's equal. And if you're owning a treasury, you're not owning it to consider something alternative. You're owning it to consider something. The word is replacement. That's the word. You want to replace or substitute, not even substitute. You want it to be an equal. And there is no equal to treasuries out there except for gold bullion. In fact, I would argue that there is no equal to gold bullion out there except maybe treasuries.
Silver markets experienced a significant rally in the early hours of Thursday, pushing higher with strong momentum. However, given silver's inherent volatility, traders must exercise caution. The market tends to be noisy, and prominent positions can lead to substantial risk if not managed properly. Despite this, silver appears to be attempting a breakout, though it is still contending with the resistance of last Friday's massive shooting star formation. A decisive move above this level could open the path toward the $35 region. Silver typically follows gold's movements. While gold has shown some early struggles in futures trading, its overall trend will likely influence silver's next move. If gold faces downward pressure, silver could follow suit. However, market sentiment remains tilted toward the upside, making short positions less attractive. Instead, many traders are looking for better entry points to buy silver on dips. VinceLanci highlights that silver forms a measured move pattern resembling a rounding bottom. This is considered a strong technical formation, more robust than a traditional V-shaped recovery. If silver breaks its current resistance, it could follow a trajectory similar to a fishhook pattern, potentially reaching levels around $34.80. Let's get back to the interview.
Let's start with silver. Yesterday, I mentioned concept of the measured move starting to play out in silver. And I was a little bit concerned about the structure up here. I thought that it could be a source of resistance. Well, here's your measured move. Basically, you take it's not a V, but it's kind of a rounding bottom. And this shape is actually better than a rounding bottom. Okay. From here to here, measured move. If we break this, we should go up kind of like a fish hook we talk about in Founders. We should break this. It actually takes us to 34.86. 34.80 is what I rounded it to. And then I just threw the arrow in there. So the structure doesn't stop it from getting to its level. The structure is actually part of its level. We could therefore test this level again. Anyway, I'm more friendly. Obviously, it's easy to be more friendly when the market's higher. But as long as we're above, say 32.40, then the market's fine. Now, you may know that I was long silver and I got out of it right before this spike, of course, right? And then I got short gold, and we'll talk about that in a second. Gold, dabbling in polytrends. We'll talk more about that when I have something else to say about it. So far, so good, though. So there's the new high, a new all-time high. Goldman's report comes out. We get a new all-time. Look, Goldman's level is just low. I think they're doing it on purpose. I think they're buyers. Now, I wouldn't call this one of my measured move rounding things, but it could be. It could very well be. This one was to there and then up. See this? You see this in silver now, right? right? We had this in gold. We had a structure above. Jesus, it's a replication. Gold, retracement, break, and this structure wasn't a problem. Oh, let me go back to silver. Now it looks juicy. All right. Dip, retracement, structure above. Same damn thing. And most people will say, who don't understand technicals, will say, well, it's just a coincidence. No, it's not a coincidence. Charts are mirrors of human behavior. Anyway, gold. I have positions on, and I'm going to discuss that in premium very quickly because I know there's some traders out there who have been asking me questions because I was short. I'm going to go into that quickly to give you some feel for the logic behind it and how I expressed it, which is more important. I'm a very options-oriented person. All right, checking back with the markets. That's pretty much it. Gold's up 10, gold's up 11, silver's up 34, so chopping around. It's 8:13 now, so if we weather the next half hour, then there should be buying again. There was buying yesterday. There'll be buying again coming in between 9 and 9:30. What happens the rest of the day is a different story. But I'm telling you, if you can weather the next 15 minutes and you are a short-term trader, you buy it and you sell it at 9:30. Very similar to buying the U.S. close, letting it go up during Asian hours, and then selling the London Open. Same idea. It's a little bit of an echo trade.
The steady decline in foreign-held U.S. Treasuries and the growing preference for gold signal a more profound transformation in reserve strategies as global markets shift. Meanwhile, silver's technical setup suggests the potential for a breakout, though volatility remains a key factor for traders. With central banks and investors adjusting their portfolios, the landscape for precious metals is evolving rapidly. Do you believe gold and silver will continue gaining traction as reserve assets, or will market forces drive a different outcome? Share your perspective in the comment section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.